Well, it's such a pleasure and honor for me to welcome to this conversation Professor Bruce Greenwald, the Robert Heilbrunn Professor Emeritus of Finance and Asset Management at Columbia Business School and the Academic Director of the Heilbrunn Center for Graham and Dodd Investing. Professor Greenwald has been recognized for his teaching abilities, and I've heard it firsthand from many of his students as well. He has received numerous awards, including the Columbia University Presidential Teaching Award, and all of us in the value investing community really do look to you, Professor Greenwald, as somebody that has guided us for many, many years in our endeavors in value investing. And you've been such a steadfast guide and advisor whose wisdom we all very much appreciate. So welcome.
Thank you.
And you have blessed us with another gift, which is the second edition of your best-selling book on value investing. Now, it's been quite some years since the first edition. How many years exactly?
It's 20. My timing, by the way, is perfect. So the first edition came out in 1999 when everybody said value investing is dead. And the
Right.
second edition has just come out when everybody is again saying value investing is dead.
Exactly.
So it's this 20-year cycle that I've managed to hit at the peak both times.
May not be optimal for book sales, but it's optimal for making all of us money going forward, I believe.
I agree.
Because we are truly at probably an unprecedented point in time in terms of the disparity between growth and value.
I think that's right. What I'm going to talk about, though, today is that I think this situation is really different from 1999. That in 1999, I think that the internet boom had just driven everybody crazy, and the valuations were sort of completely devoid of any rationality. And they were all, of course, for several years, producing enormous returns for non-value investors. I think this time there are fundamental changes in the economy that are not going to go away, that are not sort of temporarily crazy, that value investing is going to have to adapt to. So I think in that sense, the timing of this book is a little better than the timing of the last one. And if you'd like, I can go ahead and talk a little bit about both what the situation is and what I think it is that's going on that's made all the difference.
That would be wonderful, and I can then follow up with questions.
Okay, so the first thing I think to recognize is that if you look at the statistical evidence, you look at reasonably well-developed models of value versus growth, you'll see that the value premium is still there, but it's substantially gone away. I think the second thing is that if you do just the very crudest sort of cheap stocks and calling them value stocks and expensive stocks and calling them growth stocks, by that very crude measure, value is underperformed by as much as 10 years. And you've got a lot of hitherto very successful value investors who have underperformed for 10 to 15 years. So there is definitely a long-term set of issues here about value. When you talk, though, about value, I think that it's really important to be clear about what it is so that you're not throwing the baby out with the bathwater. So I think that there are basically four underlying principles that constitute a value approach, and sort of a follow-on sort of corollary of those principles. And I think we want to start there and then talk about why the corollary doesn't apply. So the first basic value principle, sort of principle zero, is the recognition, and you see this in Graham and Dodd, and you see this actually in all good investors, investing is a zero-sum game. The average return to all investors has to be the average return to all assets, which is essentially what the market return is. And that applies broadly, and it applies asset class by asset class, because everybody owns everything. And the derivatives, the uncovered shorts, the warrants, the options and so on, all have a buyer and a seller, so they just net out. So the first thing you always have to ask if you're a value investor, any investor, is why are you going to be the one who outperforms? Since on average, people are just going to perform at the market level. And I think the way to think about that is every time you buy a security thinking it's a good idea because it's going to do better than other security choices or investment choices, somebody else is always selling you that security because they think it's going to do worse than other investment choices. And one of you is always wrong. So you want to ask yourself, why, as a value investor, are you going to be more often than not on the right side of that trade? And I think the traditional answer, first of all, has been that value investors look for opportunities that take advantage of deep-seated behavioral irrationalities. So we know that people overpay for lottery tickets, that they buy them with great abandon in their crappy investments. Nobody has ever gone broke arranging a lottery. And so glamour stocks, the get-rich-quick stocks, are pretty much always going to be overvalued in some degree. Secondly, that people don't like to spend a lot of time thinking about ugly, disappointing, potentially loss-making, and therefore very cheap stocks. And I think focusing on the latter, which is the value approach, is still going to have some value to it, although, as I pointed out, statistically, that value is diminished. So that's the first thing I think you don't want to throw out. You just want to think intelligently about that. The second value principle really is to know what you're buying. I think that's why it's called value investing, because you've got to be able to identify the value that you're paying for. And that really is about, and historically has been about, Graham and Dodd approaches to putting value on securities. Earnings power value, asset value, and triangulating the two are really superior because, among other things, they do look carefully at balance sheets when DCF projected based values don't, that they really are and have been better than traditional valuation approaches. So I think you want to have a better approach to deciding what you're buying. And the third thing I think is, in terms of after you know what you're buying, is to be very patient and to be willing to wait to see that there's a margin of safety and you're getting it at a price with a significant gap between that price and the value that you're buying. And I think, again, patience and discipline in that sense hasn't gone away. I think the problem is that because value investors concentrated on knowing what they were buying, they weren't willing to buy the future. So almost by default, it became the case that a value investor would not pay for growth. And actually, it turns out, if you think about the history of investing, and it really is relatively short in terms of sort of the broad number of investors that we think about, investing in growth was actually, for the most part, not a particular advantage. So in the wake of the Depression, in the wake of the Second World War, nobody is going to take any chances. So not being willing to pay for growth just puts you in the same bucket as everybody else. And then sort of starting in the 1950s, late 1940s, with the Nifty 50, you got investors who really looked for buying growth companies and looked for buying just the great American corporations, General Motors, General Electric, DuPont, US Steel, RCA, and so on, and paying for the growth. The reason I think that didn't work is that literally from 1950s rather, to the late 1980s, growth has produced disappointing returns. And the reason for that is that the dominant economic force over that period has been globalization. And what globalization has done is you go from a national market where General Motors is the dominant competitor. It has economies of scale and significant competitive advantages that create barriers to entry, to big global markets that nobody dominates, where there are no barriers to entry. And the fundamental fact about growth that I think increasingly these days is appreciated is, if you don't have a market that's protected by barriers to entry, where you have as an incumbent competitive advantages, you're not going to make money from growth. And that's clear, I think, in the case of organic growth and revenue, because if revenue grows, typically in the short run, you'll do better, but ultimately other people are going to see those profits. You're going to get a lot more entry. You're going to get expansion by existing firms, and the profit opportunity is going to go away. Same thing applies to sort of margin growth, where changes in technology reduce costs. If there are no barriers to entry, your profits go up temporarily. Everybody sees it, and they crowd into that market. And again, the benefit of the growth just dissipates. When you think of active growth where you're investing, if you're investing in a competitive market, you're not going to earn 15% if the cost of capital is 10, because everybody else is going to see that opportunity. They're going to take advantage of it, and they're going to drive that 15% return down to the 10% return. So even in active investing, if you don't have a market protected from competition by barriers to entry, you're going to earn 10% on the investment. You're going to have to pay 10% if that's the cost of capital to the people who provided you with the funds, and the net benefit is going to be zero. So growth, again, has no value. And that was a trend, that trend from markets that could be dominated and were protected by, in the Buffett terms, moats, to globally competitive markets, meant that over time, the value of growth was undermined, and the value of growth, therefore, was disappointing. And if you didn't buy growth, you tended to do really well. That trend has reversed. As we move from manufacturers' goods to services, and manufacturing is dying these days just the way agriculture died sort of in the early part of the 20th century, you go from big global markets to local service markets where goods are locally produced and consumed. And those local geographic markets are small enough that they can be dominated by local competitors like Walmart. And once Walmart dominates the market and has the benefit of economies of scale and customer captivity to protect the market share that underlies those economies, Walmart is going to start to earn above the cost of capital. If it expands widely by, say, adding food within the area where it has economies of scale, it's going to get above cost of capital returns. If it expands widely to adjacent markets, which is what Walmart did, it's going to make above cost of capital returns. If costs go down, entrants simply can't get the necessary scale in that relatively small market to compete with Walmart, which dominates it. And so you're not going to see entrants competing away the benefits of growth in revenue or the benefits of growth in margins as costs go down. So all of a sudden, as you go from very big global markets to small local markets that are basically service-based, and this, by the way, applies to manufacturing firms. You look at a company like Deere, the part of their business that is making tractors and selling them in a big globally competitive product market has shrunk. What they really do is they provide local service support. They provide local software that runs those machines off GPS systems and places every seed in the ground individually at optimal times. You have local secondhand markets because the machines last for a long time. And because they can charge a lot for these extremely valuable machines, they finance the sale, which is based on local information about who's a good risk. So when Deere dominates the United States or regions within the United States and has 90% of the agricultural equipment in that sector, there's just no chance that anybody's going to buy a Kubota or an AGCO tractor. So this applies equally to manufactured goods as services, local services become a bigger part of the package. And you see this, by the way, in the share of profits in national income. So at the end of the 1980s, profits were about 8.5% of national income. Today, that number is about 13.5%, because globalization is essentially being reversed, and technology has reinforced this trend. That if you think about the old technology companies like IBM, they did everything. They did the chips, they did the software, they did the hardware, they did the peripherals. If you look at the technology companies today, they're very highly specialized. Oracle does only databases. Microsoft does operating systems and adjacent software. Intel does only CPU chips. Oracle does only, fonts and graphic material. Google does only search. And again, once you get disaggregated markets like that, and technology has enabled people to put systems together from, many different suppliers, those tend to be small niche markets. In a sense, they're local markets and product geography. And you get dominant competitors in those markets who can keep other people out because they have the scale economies and they have the customer captivity to deny those customers and deny the necessary scale to entrance. So we're living in a world, as those trends continue, where growth turns out, because franchises are getting stronger, to be more valuable than people thought it was. So if you're not looking at growth, and also, by the way, you're not looking at intangible assets, because that has also changed with these technologies and the trend towards services, you're not going to do a good job of buying where the real opportunities are. And I think that that is the fundamental change that value investors have to come to terms with. They have to be much better at putting a value on and intelligently buying growth. They can't just do what Ben Graham and David Dodd did and say, look, we just don't do growth. And that's a long answer, but I hope that's a useful answer.
Absolutely. Well, if I may ask, on the growth point, there's also, it seems like on the flip side, there's a lot of value destruction due to obsolescence of, older technologies. And it seems
that's absolutely right. And here's the thing. If you're in a competitive market and you go out of business because you're earning the cost of capital on your investment and there are no economies of scale, as you go out of business, the operation doesn't get less profitable. And you typically recover capital to cover the lost profits, because you have, say, 100 million invested, you're making 10 million a year. That 10 million goes away, but you get your 100 million back because it's working capital and fixed capital that you just allow, to depreciate. And you make ultimately something close to your 100 million back. So that in a world of competitive businesses, lack of growth, that is negative growth, these disruptions don't kill you. In a world of franchises like newspapers, destruction of franchises, negative growth is deadly, because now your fixed cost is spread over a smaller and smaller base. Your product gets less attractive because the network effects go away or go to some other sector. And because you're earning 40, 50, 60% on the invested capital, the capital you recover comes nowhere near to compensating for the lost business. So you're absolutely right. The second half of this is, you look at dying businesses in a franchise world, you're going to get murdered. And I think that hurt a lot of value investors who thought they were going to get rich buying newspapers and similar businesses. So that's absolutely right.
And now, of course, we see that in a lot of sectors. I'll just say energy, which is down to probably its lowest as a percentage of the S&P in history, perhaps. And how can we think about looking for value in a sector like that, which over time is getting disrupted, is going to shrink in certain ways, and yet it seems like, investors may have overreacted on the negative side, meaning,
I would be okay.
yeah,
Here, I think you've got to be really careful. Those are competitive businesses. These are commodity businesses you're talking about. The history of commodity businesses, and this includes, by the way, energy, is that in the race between improvements in technology and the exhaustion of readily accessible resources, including, by the way, the atmosphere, improvements in technology have won hands down for 200 years. So actually, even though that oil does very well for a period starting in roughly 2003, 2002, historically it's done very badly. I mean, so you look, again, there's a brief period in the 70s and early 80s where it does well, and then it does badly for 20 years. So I think, first of all, if you're going to intelligently buy natural resources, you've got to be a very strict value investor and not look for growth at all. You want to make sure the asset value is there. You want to make sure the earnings power value is there. And you want to make sure there's a margin of safety. So in commodity businesses, I think your advantage as a value investor is going to be the second two forces that we talked about. Well, in a way, when oil does badly and it's disappointing and it's no longer glamorous, we know people overreact. So you want to look at that possibility. You want to put a value on what you're buying that's better than you can do with one of these speculative DCF calculations based on unreliable projections of future oil prices. And that's basically doing an asset value, doing a current earnings power value, and triangulating between the two, which is the Graham and Dodd approach, which is better. So you've got to have an appropriate approach to those investments. And third, you've got to be patient. I mean, once you've got a value, you may very often find that even though it's a bad sector, it's still not a bargain. So I think you want to be in that area a strict value investor. Now, I think there's something else that's come into play as you start to pay for growth and as you start to think about these changes. When you buy growth, when you look at the possibility that shrinkage is going to kill you, you're really focusing on the future. Focusing on the future, and that's also what you're going to be doing increasingly in this era of disruption in commodity markets, is a really hard thing to do. I think what that means is, and this is the last piece of advice I give people, is if you're going to invest in oil, you better be an oil specialist. You can't be a generalist. So imagine that I do South Texas Gulf, I trade or invest in South Texas Gulf Coast onshore oil leases. It's all I do, and I've done that for the last 20 years. And you fly in from New York and buy an oil lease from me, or you fly in from Germany and buy an oil lease from me. Who do you think is going to make money in that transaction? It's obviously going to be the expert. So I think the last thing that, and this is a big change, I think, for a lot of value investors, is you're going to have to specialize. And you're going to have to specialize by industry. So you're not going to be able to do all commodities. You may be able to handle 2 or 3. And by geography. I mean, actually, if you look across oil companies, the oil companies that do well are not the oil companies that try and go all over the world. They tend to be the oil companies that have basin specialties, that dominate a small number of basins, invest in those basins where they have informational and knowledge advantages. So I think that, again, you want to have a sense of actually looking for the disaster areas. You want to have a very good valuation-based, value-based approach to knowing what you're buying, which is a good valuation technology. And you want to be very disciplined about it. And to do that well, I think you've got to be an expert. And that's a big change for value.
And just to continue on that idea of specialization, one of the four principles you just mentioned is to know what you are buying, or the concept of circle of competence. Would you say that also applies to investors who are now looking to find value in growth? Because you need to assess growth more,
Absolutely. That is true in spades. And let's actually talk a little bit about how you value growth, because I think that'll give you a feel for how hard it is and how important it's going to be to really know that business and be specialized. If you think of a growing firm and buying a growing firm, most of the value is way out there in the future. Typically, when you do a DCF on a growth stock, you'll do 5 years of cash flow projections, and then you'll do a terminal value. And somewhere above 80% of all the value will be in the terminal value. The terminal value will be a terminal cash flow times a multiple, and the multiple is 1 over the difference between the growth rate in that terminal cash flow and the cost of capital. So, if the growth rate is 4 and the cost of capital is 8, it's going to be 4% is the difference. So the multiple is going to be 1 over 4%, or 25. But suppose you're off by 1% in either of those numbers. Suppose the growth rate is not 4%, it's 3%. The cost of capital is not 8%, it's 9%. Well, 9% minus 3% is 6%. 1 over 6% is 16 times, not 25 times. On the flip side of that, suppose the growth rate is actually 5 and the cost of capital is 7. And these are 1% errors in projecting a long-term future. Well, 5 minus 7 is 2%. 1 over 2% is a 50 times multiple. So within really a very narrow range of forecasting growth rates and sort of what future risks are going to look like, you can get a 3-to-1 variation in multiples. So you better be an expert if you're going to play that game. And I think, by the way, you cannot put a number on things. I think if you're going to buy growth, what you're going to have to do is not say, this is what it's worth, because you're going to get those problems that we just described of inaccuracy. What you've got to say is, if I buy at this price, what kind of a return am I going to earn? You've got to look at these growth stocks in return space. So what you're going to do is you're going to do an earnings power. The assets are probably not going to matter because it's going to be a franchise business. You're not going to invest in any growth if you don't have confidence in the existence of a franchise or the barriers to entry. So you're going to verify that they do dominate their market. They have customer captivity or proprietary technology. There's real market share stability, that an entrant to be viable has to get to, say, a 20% market share, and 0.2% changes hands of market share every year. So it's going to take them 100 years to get there, which is a powerful moat. So you're going to verify all that. Then you're going to say, okay, as that franchise sits there today, what's the earnings power? And that's going to be a traditional earnings power calculation. And you're going to divide that number by what you're paying for the company. And that's a cash return. And this is an enterprise value. So say, you think you're going to make 100 million and you're paying 1.2 billion. That's an 8% earnings return. Now you don't get all that. So you can't just stop there, because the management is going to give you some of that in cash and they're going to reinvest some of it. So you have to have a feel for how much of that you're going to get in cash, which is, what's the distribution policy look like, not only now, but in the future. So say you think they're going to distribute half of that 8% earnings return, you're going to get a 4% cash return. Everything else has got to come from growth. And the growth is going to have two sources. One is, and here I think it's important to recognize, is just organic growth. That because the market is protected by barriers to entry, organic growth in demand and margins from cost reduction is going to benefit you. But you have to know what those numbers are going to look like. You have to know and be able to forecast what these long-run growth rates in revenue are going to be. And typically, by the way, because you're talking about long-run growth in revenue, it's not going to be above more than 3% above GDP growth. If it's temporarily growing at 20% faster than GDP, that's not going to last, and you're not going to be able to tell when that stops, and that's just going to be too tough to call. So you're going to have a long-term growth rate of revenue, and you're going to have a long-term trend in cost reduction, which is going to improve margins. And to understand both of those, you better really understand industry demand and how it's evolving, and industry technology and how it's likely to evolve. And then you've got the 4% return that they're reinvesting. And what you get for that depends on how good the management is at capital allocation. And that's going forward too. If they're terrible at capital allocation, and there are companies out there that typically earn about 20 cents on the dollar for everything they retain, and understanding that number requires real industry knowledge, that 4% is going to be worth less than 1%. If they've got a very disciplined strategy, they spend money first on cost reduction, and when they grow either at the margins of their existing markets where their economies of scale carry over, or like adding products, food products for Walmart within the markets they dominate. You could have a case where every dollar reinvested earns $2, in which case that 4% would be 8%. But you better understand the evolution of that management, how good they are at capital allocation, and that's a lot of detail. And then once you've got that number, which consists of the cash return, the organic growth return, and the active reinvestment return, you got to compare that to the cost of capital, because you want a margin of safety. So if the cost of capital is 7, which is a reasonable cost these days, you want returns at least 10, 11 maybe. And here I come back to the very good point that you made earlier. These franchises don't last forever. If this franchise lasts for 50 years on average, and it's a random event when it dies, that is dying at about 1.5% a year, which is 72 divided by 50. This is a 30-year franchise. That franchise has an expected death rate of 2.4% a year. And your margin of safety has got to cover that. Well, being able to make good judgments about how long these franchises are going to last is very industry specific. So again, you better be a real industry expert. So I think that in every dimension, you start buying growth and you think you're going to do it as a generalist, you're going to get in real trouble. And I think actually, if you look at the value investors who've done well, and these are the ones that we've included in the book in this edition, as opposed to the last edition, they're all very specialized. They're usually specialized by industry and geography, or they do very specialized kinds of securities and kinds of investment.
Would you say that in order to be successful these days, we are not just security analysts looking at the numbers, but also we need to be judges of people or management teams more and more? You know, Buffett, I believe, is famous for saying, buy a business that's so good that even a fool could run it. And that really doesn't seem to apply anymore in the world where so much of the value depends on the future. You know, you think of an Amazon, if they had stayed a bookstore, they would have had a totally different outcome than given Jeff Bezos and what he has done. So how important has assessing management become in your view?
Well, I would say two things about that. The first thing is you got to understand the industry, because Buffett also said when an industry with a good reputation, or sorry, a management with a good reputation meets an industry with a bad reputation, it's invariably the reputation of the industry that survives. So you better understand in detail these trends. And by the way, there is a common mistake about industries that value investors make. So one of the things that I cannot beat out of my students is They say, oh, this is a really powerful franchise, so I'm going to pay a higher multiple for it. Powerful franchises are all in the earnings, presumably. So you're already, if you give it a higher multiple, you're double counting. What you care about is the durability of the franchise, which is the point you raised early on in the context of disruption, and the rate of growth of that franchise, which depends on the ability of management to make those earnings from the franchise grow. So you got to start with detailed industry knowledge. And then, yes, of course, you've got to be able to judge management. But here's the thing. Knowing a good management without knowing about the industry economics is a tough thing to do. Knowing a good management, if you can't really talk to them frequently so that they're a long way away or the managements you're monitoring are sort of all over the globe, is going to be a tough thing to do. So I absolutely agree with you that you've got to be really good at judging management as well as, of course, judging the industry. And Jeff Bezos got lucky in some of that because there are other people who did try and grow the way he did, and it just didn't work out at all. And to do that well, you've got to be locally focused, both in geography, so you can talk to these managements and probably focus on managements who are below the radar otherwise. And in terms of the industry, so you can really judge when they start making stupid decisions.
You talked a little bit about profit margins and how they've evolved over time. I believe profit margins used to be viewed as one of the most mean reverting series there was, but that seems to have not been the case, the last decade or two. Would you say that profit margins can stay high, quote unquote, for forever, given that specialization and of various businesses? And does that mean that we have become, in a way, less capitalistic because maybe the businesses have gotten smarter about carving out niches versus competing on a commodity basis?
Okay, let me actually speak to that because I think there is a really good point that underlies that question, and it is this. Mean reversion is a characteristic of the time frame that you're talking about. So if you're talking about business cycle time frames, periods of 5 to 7 years, yes, you're always going to get mean reversion. If you get very high profits for a short period, they're going to mean revert over 4, 5, or 6 years. If you have very low profits, they're going to mean revert over 5 or 6 years. And that hasn't changed. But here's the thing. There are longer time frames. And in those long time frames, you typically don't get mean reversion in profits. So if you look from 1946 to 1980, for sure, returns on capital and therefore profit margins fall consistently. And they, over that time period, they fall by a factor of 2. It's sort of like the fact that people forget that over 200 years, commodity prices have continued to fall because they don't look at those very long time frames. And really, I think if you're going to be investing in growth, because so much of it is out, the value is out in the future, you're going to be looking at long-term time frames. And there you don't see mean reversion except at very low frequencies. So as I say, from 1946 till probably the late 80s, although it's very hard to judge when these turning points are, you see steady deterioration in profit margins, steady increases in competitive intensity, steady reductions in the value of franchises. Once you look at the late 1980s and you look at what's happened since then, first of all, the nature of the great companies has changed. I mean, it's the United Healthcares now, it's the Deeres that understand the local component of manufacturing. It's a service business like Amazon. It's a service business like Walmart, although it's being disrupted by Amazon. It's a non-traditional manufacturer like Google or Microsoft. It's Apple, where the manufacturing costs are negligible. And I think that when you look at those kinds of companies, they dominate particular niches, small product markets, and they dominate geographies. So Google is nowhere in China. I mean, Baidu dominates China. So I think that the trends that we're looking at that have empowered or created unusual value to growth and have led to this growing share of profitability are long-term trends. I mean, do you think the trend towards services is going away? I don't see that. I don't know what's going to replace services, but right now, that's the game, and it's the game all over the world. And the countries that are sort of still manufacturing economies like Japan and like a lot of the Europeans have gotten in real trouble because they haven't adapted. So that's a trend I don't see going away. And it's a trend that empowers companies and empowers smart managements, as I say, especially with geography, to stay out of each other's way. I mean, one of the great things that's happening, I hope, and continues to happen in agricultural equipment is that these companies are defining their own geographies. So the Deere is dominant in North and South America and Australia. AGCO is dominant in, or sticks to Europe pretty much. And Kubota sticks to sort of wet rice kind of agricultural in Asia. And once that happens, you're absolutely right. Competition goes away. So that you've got dominant competitors in each of these several markets. And it's just not worth it. It's just not economic to go after each other. I think that geographic trend isn't going away. And ask yourself this. When you look at social media, what's the trend? It's getting more and more specialized. It's LinkedIn, it's Instagram, it's TikTok that do only certain specialized things. So that trend towards specialization in technology, I don't see going away either. But here's the thing. You have to understand those trends because someday they are going to change. And the only way you're going to understand how they impact your investments is to understand how they impact the industries in which you invest. And that means being an industry expert and how they impact the geographies in which you operate.
And just to ask you about a counterpoint there, I've heard many people say, well, because investors have become so specialized, there's now value in being a generalist and making connections that the specialists cannot make. And, what would you say to that?
Well, I mean, the empirical evidence is against that. I mean, if you, for example, and they've known this for a long time, if, there are these big fund companies that offer industry specialized funds. If you built a portfolio, and it could just be a S&P type valuated portfolio of those specialized funds, they typically outperform the generalized funds from the same companies. So I think the empirical evidence is against that. As I say, if you look at the value investors whose performances have not deteriorated, they tend to be the ones who are specialized in this environment. It's hard. And again, I think let's just go back to the fundamental test. Again, suppose I'm an expert in agricultural equipment and I invest in agricultural equipment stocks. And you buy a Deere stock from me. You're buying and I'm selling. Who do you really think is going to be on the right side of that trade? Now, sometimes I will have missed a broader trend. But this is, again, something that value investors tend to do, and it's tended to have benefited them. They tend to look for stability. So if an industry is changing really rapidly, they put it on the too tough to call column. And they look for temporary problems that are going to go away in a stable economic environment. I think that the sort of things that you're talking about that would benefit a generalist are going to be things that are dramatic changes from outside an industry. And they're going to be rare, and they're going to be very hard to forecast. And the impact of those changes on the industry itself are going to be hard to forecast. So on average, I think you're going to be much better off understanding the current stable industry structure, especially when it comes to trying to forecast it over 10, 15, 20 foreseeable years. Then you're going to be coming to that industry with some brilliant insight and doing it. I think if you understand Sweden, you're not going to be somebody who does well in a really dense economy like China. I mean, Sweden is a bunch of small markets broken up by mountain chains. China is these very dense markets along the river valleys and the coast, like New York, and it's just a very different economics. So I would still say that you're going to have to start by being a specialist. Now, if you're really, really smart, you can do 8 or 10 industries. I mean, Warren Buffett has done 4, which are consumer non-durables, old media, insurance, and banking. And actually, when you look at him in other areas, he hasn't done nearly as well as in those 4 areas. So I think the evidence and the logic still argues in favor of specialization. But, and here's the big problem, when you define risk properly as not upward variation, but downward variation, which is loss, and not temporary fluctuations or variations, but long-term permanent impairment of capital, turns out that in that context, most of the permanent impairment of capital events are unsystematic. They tend to affect, it's like the newspaper is going away and so on. They're not necessarily economy-wide events. That means that diversification is really important. And it's hard for a specialist to be diversified. So there is this other function that's out there, and I don't think it's an investment analyst function. I think it's a portfolio management function, where there are going to have to be people who are really good at speaking to the industry specialists and eliciting how much confidence they have in their choices, how reliable their sort of projected returns are, and how correlated they are with other returns so you can sensibly build a portfolio. So the role for a generalist is not completely gone away, but it has changed a lot.
And perhaps as we wrap it up, just a question on being an investor, given how broad a swath of investors you see and have followed for a long time, and some value investors have done well through the decades. Some seem to have really not adapted to the times, if you will. What would be your advice for a value investor in terms of evolving as an investor? And I'll just add, I've heard it's thrown out that, this notion of style drift and that's a bad thing. And so I feel like a lot of investors have really stuck to their guns because they don't want to be accused of drifting. But how does one evolve in the right way?
Okay, so the first thing is, the crucial part of what you just talked about is, what does it mean to stick to your guns? Oh, if you were an asset investor, for example, so you were Marty Whitman or people in that camp who really focused on real assets. Real assets have gone away. Assets are overwhelmingly intangibles these days. So the old metrics that you applied didn't apply to a lot of businesses. And very often the businesses that you had to look at where there were bargains, there were really fundamental problems because you didn't have a very broad choice. So there, if you didn't adapt, I think all those old-fashioned asset-based investors got in real trouble. So that's the first thing that I'd say. Second thing I'd say is that when you say style drift, you have to have a fairly Catholic view of what your style is. So when you say don't drift from a value style, I think, first of all, increasingly today, that means don't drift outside your specialty, because that's what's going to put you on the right side of the trade. And that's something that Graham and Dodd and Buffett are acutely aware of. So Stick to your specialties. The second thing I think is embrace a value orientation in looking for stocks within an industry. And if you have 2 or 3 industry specialties, concentrate on the one that's sort of the sickest. I mean, that is those fundamental human tendencies haven't gone away. So sensible search strategies are where you're always going to start. And once you've evolved a sensible, specialized, value-oriented strategy, don't go away from that. Secondly, remember, value investors should have superior valuation approaches. And the one thing we know about valuation approaches is one size doesn't fit all. So what people get taught in business schools, which is everything should be a DCF, is just idiotic. So for example, if you're doing event-based investing, which is inherently short horizon, and if it's fixed income, so the payoffs are quite clear, you can go ahead and do a DCF because you're not going to be going far out into the future. The payoffs are going to be clear, and it's going to be all about probability weighting of well-defined scenarios. So for that, a DCF is a good way to go. If you're going to invest in competitive businesses, real estate, raw materials, natural resources, agricultural products, competitive businesses like steel fabrication and so on, you know that growth is going to have no value. So if you do a stupid DCF forecast that is going to be incredibly sensitive to the assumptions, it's not going to be a good valuation procedure. You're going to want to look for asset values, valuing, by the way, the intangibles in a sensible way, as well as the tangible assets. You're going to want to look for earnings power values, and you're going to triangulate those. Now, you're not going to have a simple multiple that you're going to be able to apply there, because it's not going to be that simple. You're going to have to apply this approach, which is the Graham and Dodd approach, which is much superior to a DCF approach where it's appropriate. And if you're going to invest in franchises, which are going to be increasingly a bigger part of the market, you're going to have to do this return-based calculation. And when you do the return-based calculation, you've got to consider things like franchise fee in your margin of safety. And it's a different way to proceed. And also, by the way, I think in that case, you've got to accept the fact that making the sell decision is going to be brutally hard, because you're not going to have a value you can compare to the market price. And these returns are relatively insensitive to market prices. So you're going to have a policy. Buffett's policy was never to sell. I mean, Seth Klarman's policy originally was never to pay, I think, more than 16 times earnings. It's drifted up in this environment, but it's still, and it's just an arbitrary policy. And you have to stick with it. You have to stick with your valuation discipline and using these approaches as frameworks to do very good research and identify exactly what you're buying. And if you drift away from that and start doing multiples or start flashing on things, you're going to get in real trouble. So it's sticking with the sound valuation approaches and sound research approaches, which I think, again, are going to be specialized almost necessarily. And then you got to be disciplined. I mean, you got to monitor your behavior. You can make a mistake once and it's probably forgivable. But if you make the same mistakes over and over again, you are not keeping track of your own record. And I think you've got to be really careful to monitor your own discipline. So I think it starts out the way we talk about things, which is having a sensible search strategy where you're going to find opportunities where you're likely to be on the right side of the trade. Sticking with that, having valuation approaches that are both appropriate to each of the opportunities you look at and are applied consistently and rigorously, and having a disciplined approach to the buy decision and having some appropriate disciplined approach to the sell decision. And I think if you don't drift away from that, and there are value dimensions to all of that we've talked about, I think you're going to continue to do really well. And the people I know who've done very well in this environment. So there are people who over the last 15 years, when value has not done well, have outperformed their markets by 8 to 9% a year. And they've typically done it by being specialized.
Well, Professor Greenwald, this has been so wonderful. Thank you very much for your wisdom, and thank you for giving us the gift of the new edition of your book, which is really nice for all of us to have, either for Thanksgiving or those who don't have it yet in time for Christmas. We really look forward to it. Thank you
Yeah,
so
can I do
much. Yeah,
two valedictory ads?
please.
First, the questions have been just terrific. So I hope your viewers appreciate that
Thank
as a
you.
general principle. You're specialized in questions and you do it really well. Secondly, the first value investing book from Buffett, Graham to Buffett and beyond, which sold over 100,000 copies in English and probably a couple 100,000 or more around the world, is not a particularly good book. So the second edition actually is a much better book, and it's good enough. So like the Competition Demystified book, we're never going to do a third edition. So if you buy this one, it'll be the last one you ever have to buy. Thank you.
Wonderful. Well, thank you so much for pointing that out. I have no doubt that everyone listening would have bought the book anyway, but with this extra selling point, I'm sure we'll be gifting copies as well. So thank you, Professor Greenwald. Great pleasure to have you. Really appreciate your time.
Okay. Thank you.
Goodbye for now.
Bye.